In value investing, we hear one message all the time. Be cautious, protect the downside, demand a margin of safety. All are true. But there is a second skill that separates the greats from everyone else. What do you do when you find a rare opportunity where the odds are heavily stacked in your favor? Do you act small or do you size it like it matters? Today, I want to show you two clips that might change how you think about portfolio allocation. The first is Stanley Druckenmiller telling the story of pitching an unusually high conviction setup to George Soros. Druckenmiller thought he was being already aggressive, and Soros taught him what real conviction sizing looks like.
Now I'm showing my age, but I'm pretty sure it was Tietmeyer has written an editorial in the Financial Times, basically in more proper language, but he's basically saying that the Deutschmark and the pound should no longer be linked. So I decide to take Duquesne and the Quantum Fund to 100% long the Deutschmark, short the pound, because it's still 0.5% unbelievably. Now you're going to hear vintage Soros. So he happens to be in New York at the time, which he wasn't always. I go into his office and I explain to him why I'm going to 100%. And he had a rather large personal account. That's how we kept each other out of each other's hair. He traded that and, it was 95% overlap. Told him why I was doing this. And he had this unpleasant, puzzled look on his face when I'm telling him my thesis, that this one economy is booming and they need higher rates. This other economy is falling apart. They need lower rates. That these two currencies shouldn't be linked. And I'm thinking, what does he not understand about this? Because this guy pretty much understood everything. And he says, look, this is a one-way bet. They come along very, very rarely. It's ridiculous doing 100%. We should put 200% of the fund in this trade. So there you have it.
So that means that you borrow money in the bank and double up.
Yeah, on a $7.5 billion fund, he thought we should have $15 billion short the pound, long the Deutschmark. It turns out we never got there, but it shows the way the man thinks. I saw it over and over again.
Because whilst you were trading, the thing happened.
Yeah, unfortunately, we had a pretty strong reputation. And when I started selling it that night, I noticed a lot of other hedge funds started selling it, the gossip community and the currency markets. And by midnight to 1 o'clock, the forwards had blown out. They'd started the day at 0.5%. They were like 6 or 7%. And it basically wasn't trading after 1 a.m. Then the British raised rates, I think from 6 to 9 to try and stop the bleeding. And then they went to 12. I knew it was over, but the forwards were out so much, it didn't matter. And it was done by noon the next day.
And you were sitting at your desk looking at the Reuters screen?
Yes, or whatever the screen at the time
What
was.
did you...
we only got $7.5 billion done, ironically.
Well, I have to ask you...
Had it not been for Soros, I probably would have not got to the 7.5 because, intending to do 15, I was in a bigger hurry.
So what did you feel when it broke?
There was a lot of adrenaline. It was exciting. I didn't feel bad because I thought the British economy needed it. I was gratified years later when they changed it from Black Wednesday to White Wednesday. Then I went into action after it broke because the gilts were down 2 points, which I thought was ridiculous. British needed lower rates. There's some theory in the academia that if you have a weak currency, your interest rates have to go up. So I bought gilts. I bought British stocks. There was a whole...
Because what happened was that the currency depreciated and it was good for exports, right? So the stocks went up afterwards.
Yeah, the stocks went up. The gilts went up because they needed lower rates and, they'd been held artificially high. So there was all kinds of other stuff I did around it, which is kind of the way I trade. You get a theme and then you look at the concentric circles or the dominoes that fall because of a theme. But the point was, with Soros, if he really believed something, the position could never be big enough.
Yeah.
Particularly if it's in a liquid market. And I learned from him, I like to play the turn, maybe my ego, in a big turn in something. he was perfectly happy to play from the third to the sixth inning if we go back to baseball terms. If it's a 9-inning game, he was perfectly happy to play the third to sixth inning when there was more certainty on much greater leverage. He had more courage than I did in terms of sizing positions. I don't think it totally rubbed off on me, but it certainly helped, and it was a huge learning experience. I think the major thing I learned with him is it's not whether you're right or wrong, it's how much you make when you're right and how much you lose when you're wrong.
Druckenmiller was talking about an enormous position, but Soros's point is that these moments are incredibly rare. When you have real edge, when the upside is much larger than the downside, diversification can become a penalty. In an investing lifetime, you might only get a handful of these setups. If you act small on your best idea, you are wasting the opportunity. It is not just about being right, it is about how much you make when you are right. And this is how you get the multi-baggers. Not by just letting random stuff compound forever, but by recognizing the rare moments where you basically know what you are looking at, and then having the courage to size it accordingly. A single 100% year can save you 5 years of grinding. People do not say this enough, but it is true. There is one game about getting rich, and then there is a completely different game about staying rich. This is not about being aggressive all the time. It is about being aggressive only when you have edge, clarity, and survivable downside. Now, what happens when you do the opposite? What is the cost of hesitation? For that, we go to my hero, Charlie Munger. Munger argues that the real killers are mistakes of omission.
Good morning, gentlemen. My name is Jay Parker. I'm from Washington State. And this question regards mistakes. So that being the case, it should probably be directed to Mr. Munger. Mr. Munger, I know you're fond of evoking humility to promote rational thought. So my question is, what's the most recent business mistake that you've made, Mr. Munger, and why did it occur?
I'm going to take notes on this one. The mistakes that have been most extreme in Berkshire's history are mistakes of omission. They don't show up in our figures. They show up in opportunity costs. In other words, we have opportunities. We almost do it. In retrospect, we can tell that we were very much mistaken not to do it. In terms of the shareholders, those are the ones in our history that have really cost the most. And very few managements do much thinking or talking about opportunity costs. But Warren, we have blown billions and billions and billions. I might as well say it. You're right. Right. And we keep doing it. Some might say we're getting better at it. I don't like mentioning the specific companies because we may in due course want to buy do so at our price. But practically everywhere in life and in corporate life too, what really costs in comparison with what easily might have been are the blown opportunities. I mean, it's an awesome amount of money. When I was somewhat younger, I was offered 300 shares of Belridge Oil. An idiot could have told there was no possibility of losing money and a large possibility of making money. I bought it. The guy called me back 3 days later and offered me 1,500 more shares. But this time I had to sell something to buy the damn Belridge Oil. That mistake, if you traced it through, has cost me $200 million. And it was all because I had to go to a slight inconvenience and sell something. Berkshire does that kind of thing too. We never get over it. Yeah. I might add that when we speak of errors of omission, of which we've had plenty, and some very big ones, we don't mean not buying some stock where we
a friend runs it or we know the name and it went from 1 to 100. That doesn't mean anything. We only regard errors as being things that are within our circle of competence. So if somebody knows how to make money in cocoa beans, or they know how to make money in a software company or anything, and we miss that, that is not an error as far as we're concerned. What's an error is when it's something we understand and we stand there and stare at it and we don't do anything. Or worse yet, what really gets me is when we do something very small with it. We do an eyedropper's worth of it, when we could do it very big. Charlie refers to that elegantly when I do that sort of thing as when I'm sucking my thumb. And they're really, we have been thumb suckers at times with businesses that we understood well. And it may have been because we started buying and the price moved up a little, and we waited around hoping we would get more at the price we originally started. There can be a lot of things, but those are huge mistakes. Conventional accounting, of course, does not pick those up at all, but they're in our scorebook.
Munger calls it sucking your thumb. That is exactly what I refused to do when I analyzed Reysaş. Reysaş is a Turkish real estate warehouse and logistics story that I have followed deeply for years, and it became my highest conviction idea. When I looked at the valuation, the assets, and the disconnect between market price and the intrinsic value, I felt I was looking at one of those rare moments where the setup was unusually mispriced. I did not want to look back in 5 years like Munger with Belridge Oil and say I missed it because I diversified into mediocre ideas. So I concentrated. I did not buy a small amount, at least for me. I built the position aggressively. As the thesis played out and the price appreciated, I did not trim it just to make the portfolio look balanced by conventional standards. Today, Reysaş is roughly 80% of my portfolio. To many people, that sounds insane. To a standard advisor, it sounds reckless. But if I understand this business better than any other, and it is the best risk reward I can find, why would I force myself into lower conviction ideas?
Charlie, you want to?
Yeah, if the students of America go to these elite business schools and law schools, and they learn corporate finance the way it's now taught, and investment management is the way it's now taught. And some of these people write articles in the newspaper and other places, and they say, well, the whole secret of investment is diversification. That's the mantra. They've got it exactly back-assward. The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional.
And there's nothing wrong with the know-nothing investor practicing it. It's exactly what they should practice. It's exactly what a good professional investor should not practice. But that's, there's no contradiction in that. A know-nothing investor will get decent results as long as they know they're a know-nothing investor, diversify as to time they purchase their equities and as to the equities they purchase. That's crazy for somebody that really knows what they're doing. And you will find opportunities that if you put 20% of your net worth in it, you have wasted the opportunity of a lifetime, in terms of not really loading up. And we've had the chance to do that way in our past when we were working with small sums of money. We'll never get a chance to do that working with the kinds of money that Berkshire does. We try to load up on things, and there will be markets when we get a chance to from time to time, but very seldom do we get to buy as much of any good idea as we would like to.
And by the way, I will find opportunities like TAV Airports more often. It is a great company, good idea, solid upside, maybe even very strong returns. But something like Reysaş, where the gap is that extreme and the conviction becomes that high, that comes once a decade if you are lucky. And there is another thing people never talk about. You cannot study properly and hold 15 names without help. It is not realistic. If you want to do real deep dives and then stay on top of every quarterly result, every material event, every footnote, it becomes a full-time job. For me, it takes around a month to prepare a deep dive on a single company before I publish it. Now imagine doing that for 15 companies while also tracking quarterly reports. That is 16 hours a day, 7 days a week type of work. So concentration is not just a conviction thing, it is also a realism thing. You can scan hundreds of companies and you should do that. That part is not the problem. The problem is thinking you can own 15 names with real conviction, do deep work on all of them, stay on top of every quarter, and still have the math make sense. So there are really two paths. Either you scan a huge universe and invest very broadly with heavy diversification, knowing each position is already small. Or you scan a huge universe and then narrow down what you actually want to own and then own those few names so you can truly know them and size them properly. So the key for me is this. Keep the scanning worldwide, but keep the portfolio focused. As long as nothing breaks in the thesis, I won't touch my positions. Also, the reason I am still quite bullish on Reysaş today is not because it went up and I got emotionally attached. It is because the math still works. There are two legs to it. First, there is still a gap between intrinsic value and the current market cap. In other words, there is still a margin of safety. The market price is higher than before, but in my view, it still does not fully reflect what the business is worth. Second, and this is the more important part, the intrinsic value is not standing still, it is compounding. Reysaş is investing heavily into the business, and when I run the numbers project by project, the return profile is heavily in their favor. Based on my own calculations, I am looking at returns around 15% on some projects and up to 30% on others, in real terms. And this is the key point. If the intrinsic value is growing at a fast rate, even if the stock price does nothing for a while, the margin of safety gets larger over time. Or the stock follows the business. That is why I am comfortable staying concentrated. I have no idea what the stock will do, but I know that in the long run it will reflect the underlying business. So I am holding because I still think the expected value is asymmetric. Of course, this only works as long as the management keeps allocating capital well. If that changes or if something breaks in the thesis, then the whole logic changes. But as of today, those two conditions are still in place. A remaining discount to value and a business that is actively growing that value at a high rate. If you want to see the updates on Reysaş and understand exactly why I have the conviction to size it this large, check out the Reysaş collection on Patreon. I also made the first two chapters of my most recent top gıda analysis public. The link is below if you want to read those first and see how I do my work. I am getting great feedback from current subscribers, and the monthly price is basically the cost of just one meal. You can try it for a month and get access to the entire lunch investing library. If you do not like it, you can cancel it before it renews next month. And if you do like it, there is a discount on the yearly subscription. So that's it for today, and I'll see you in the next one.